Dear clients, welcome to PhillipCapital's Weekly Market Watch. I'm Colin, Investment Analyst from Phillip Securities Research. Today, I will share on the latest earnings updates on several counters under the research team's coverage, which include StarHub, SingPost, SIA Engineering, GLP, OUE, Kim Heng, and Valuetronics, as well as a US counter, Genworth Financials. StarHub reported third quarter revenue of 553 million and net profit of 98 million, boosted by a higher adoption grant of 17 million. Total 9 months earnings was, however, down 4% year-on-year due to drag from broadband revenue decline, offset by growth in other segments. Weaker earnings in fourth quarter would be likely due to higher handset sales on strong demand for iPhones and newer phones, leading to margin compression from handset subsidies. We expect continued growth in the mobile, pay TV, and fixed network services segments, while broadband price competition should ease off going forward. SingPost recorded second quarter revenue of 220 million and net profit of 38 million. Adjusted for one-off costs in previous year, earnings for 6 months period was slightly up 0.8% year-on-year, impacted by higher operating costs. Management shared it will continue to expand its regional e-commerce logistics network through further investments and merger and acquisition activities. Development of its new integrated e-commerce hub has started and will be ready in the second half of 2016, which may lead to 30 to 40% improvement in cost efficiency and also to cater for greater growth in e-commerce logistics business. Overall, we remain positive on SingPost in view of its strong growth prospects in e-commerce and a healthy balance sheet. SIAEC's quarterly revenue dipped 3% year-on-year, while EBIT and share of associates and joint ventures plunged 44% year-on-year and 36% year-on-year respectively. Flow through to PATMI consequently plunged 41% year-on-year. Higher operating costs was due to higher subcontract costs attributed to the fleet management program business segment. Share of profits from associates and joint ventures were lower due to lower engine shop visits as customers were extending their service cycle and retiring older engines. The impact of longer maintenance cycles will result in less frequent jobs for SIAEC, but should be partially mitigated by fleet growth. GLP first half earnings was down 25% year-on-year to 269 million, hit by one-time FX losses and higher minorities. Despite a slowdown in China economy, GLP remains confident on China business with constrained supply and demand driven by domestic consumption. Earnings from fund management fee is increasing significantly with the rapid expansion of fund management platform, AUM. We continue to stay positive on GLP outlook for its market leader position and maintain our accumulate rating with lower target price of $3.03 to account for volatile FX movements. OUE results were muted with third quarter PATMI up 23% on lower finance expenses and higher associates contributions. But year-to-date PATMI representing only 50% of our FY14 estimates below expectations. We do see a visible earnings pipeline upcoming, though we reckon that it will be a while for OUE to enjoy the full benefits of the ongoing AI's projects. Slower office growth is expected in late 2015 or early 2016 with the upcoming office supply glut in 2 years. We maintain an accumulate rating with lower target price of $2.52 to account for slower rental growth. Kim Heng posted third quarter revenue of 13.8 million and net profit of 1.2 million, a decline quarter-on-quarter due to delays in arrival of customers' rig and OSBs. 9 months revenue of 57.5 million was 2% lower year-on-year, while the 9 months net profit of 6.6 million was 40% lower year-on-year due to lower margin projects undertaken. Kim Heng's current forward commitments are still high, and 6 to 7 rigs will be serviced and recognized in the next quarter, of which 2 are already being worked on currently, translating to a stronger performance next quarter. About 50% of the commitment will be spilled into FY15. Key re-rating catalysts are clinching of high-value turnkey projects and accretive M&A. On Valuetronics, results were overall acceptable despite pessimism on the stock. CE revenues temporarily stabilized, actually increasing 5% quarter-on-quarter. Bottom line is, net profits declined 8.4% year-on-year, while actually increased 6.8% quarter-on-quarter. After modeling a hypothetical negative scenario of a 20% drop in CE revenue and 10% drop in CE gross margins for the rest of the year, we still end up with a target price of 49.5 cents based on an undemanding 7 times forward PE and adding 60% of idle net cash. With about half its market cap in net cash and an 8% forward dividend yield, is worth looking at. On the last stock Genworth financials, share price plunged 40% over 2 days to $8.41 on overblown concerns of its long-term care business. Investors could have overlooked that its mortgage insurance business alone are worth nearly $11 per share. Meanwhile, it still has more than $1 billion cash and investments at holding company level and low leverage ratio of only 25%. Even if we valued long-term care at 0 and assign a low 10 times earnings multiple to the rest of its life insurance, Genworth will still be valued at $12.57 per share, representing 49% upside. That is all that we have for you today. For more information, please log on to Poems and refer to our reports on the companies. With that, I have come to the end of the presentation. Thank you for watching this week's Market Watch. I'm Colin from Phillip Securities Research. Please subscribe to us on PhillipCapital YouTube channel and Facebook. Stay tuned for more Market Watch videos.